this was a different era, we probably would see gold a lot higher right now. Bitcoin it doesn't have earnings. It doesn't have to worry about unemployment. It's mainly about is there enough liquidity to flow into it, or are people kind of forced sellers? I had to pivot my view to be less bearish than I was. You have to be aware of how much we don't know. So by not committing to like really specific forecasts, by understanding what is the direction that's likely to happen. This is not like 2008. This is not just QE. This is very forceful types of fiscal stimulus that is supported by QE, which is quite different. Homeowners and large corporations has so much low rate debt, fixed and long term, made them more resilient than I expected.
Lyn starts by comparing Bitcoin to gold, pointing out that Bitcoin doesn't care about traditional stuff like profits or job numbers. Instead, it follows the flow of money, making us wonder if there's enough financial activity or if people are forced to sell. But Lyn isn't sticking to just one idea. She encourages us to be open to uncertainty, saying financial predictions can be unpredictable. It's not a repeat of 2008. It's a story of strong financial support backed by quantitative easing, giving a unique twist to the narrative. Now, back to Lyn Alden.
Liquidity often happens in the face of weakness. And so liquidity is not necessarily correlated with the economy. It often precedes it.
Okay.
And so, for example, some of the most liquid you get is, for example, in the early parts of 2020, we got some of the biggest ever liquidity injections, but that was before the economy was still on its knees. And so that's actually sometimes where you get a divergence between, say, a purely liquidity-driven asset and a more economy-driven asset. So if you look at if you look at equities, for example, outside of like the best, 7 performing U.S. stocks, right? So all those big tech titans, many of them are expensive. But if you look at, say, U.S. value stocks, more cyclical stocks, that they've been kind of weak over the past year, in line with a kind of a somewhat weaker economy, kind of a where we have below 50 purchasing managers index for manufacturing. We have very negative readings on the conference board leading indicators, right? So a lot of economic things are soft. And then, as you pointed out, China is very soft, Europe's very soft. And so there is a lot of economic weakness throughout the world. But that's partially why there's been an uptick in global liquidity, that basically a number of authorities have found it necessary to add liquidity back into the market despite still having struggles with inflation. And so that's one factor. And that's where you potentially get a divergence between, stocks that are more tied to the economy itself can still do kind of lackluster. Whereas, if this was a different era, we probably would see gold a lot higher right now. Because gold is, it's more of that liquidity driven, like a debasement type of protection. It's not necessarily tied to the economy. And then now we're seeing obviously Bitcoin in a lot of that role, which is that Bitcoin it doesn't have earnings. It doesn't have to worry about unemployment. It's mainly about is there enough liquidity to flow into it, or are people kind of forced sellers? And as long as liquidity is decent, Bitcoin historically tends to be pretty decent. It is divorced from the performance of the economy. And so I think that's kind of what we're seeing now.
She explains that money flow often comes before economic changes, showing the difference between assets influenced only by money flow and those tied to economic performance. Looking at the current economic situation, she points out weak spots globally. In this unusual time, gold used to take the spotlight, but Lyn points out a change. Bitcoin is becoming a competitor. Bitcoin, not bothered by earnings or job concerns, becomes a symbol for money flow. Lyn unfolds the story, revealing how Bitcoin's past performance stays strong, separate from economic ups and downs. Lyn Alden shows us the art of flexible forecasting and unexpected turns in the financial dance. Let's see.
I think one reason why forecasts work out pretty well is because I try not to we have to be aware of how much we don't know. So by not committing to like really specific forecasts, by understanding what is the direction that's likely to happen. When you try to have direction and magnitude and timing, it's just like no one's going to get things right. And it's almost like bad information is worse than just not admitting you don't know certain information. So that's the first step I try to do with forecasts, is keep them kind of light, because there's just so much we don't know. There's more variables than we could possibly digest. For me, the big transition point was realizing that I've been pounding the table on the idea of fiscal dominance since 2020. And to some extent, back in 2019, I kind of pointed out that this was an option that they could pull. And once we actually started to see it pull in 2020, 2021, I kind of point out that this is not like 2008. This is not just QE. This is very forceful types of fiscal stimulus that is supported by QE, which is quite different. Um, and in 2022, my theme was basically, okay, now that they're going to start tightening, we're looking towards economic slowing, we're looking towards inverted yield curve, we're looking towards potential recession, and for much of the year that was playing out. We got all those classic things happen. But then one thing that kind of surprised me, and I started to kind of shift, and it kind of points to the need for flexibility. So, by the fact that homeowners and large corporations has so much low rate debt fixed and long term made them more resilient than I expected. And just the aggressiveness of the Fed ironically blew out the deficit even more than I expected, which ironically is somewhat stimulatory. And so one thing I started to notice by around December and January, kind of the end of 2022 going into 2023, was that the fiscal was actually starting to take over versus that pure monetary tightening to some extent. And so I had to pivot my view to be less bearish than I was throughout much of 2022. And so that, for example, I said in 2022, I'd be surprised if they're able to get rates over 3%. And that was something I was wrong on because I underestimated how quickly that feeds into, say, federal deficits that then pour out into the economy, ironically, and combined, especially because so many homeowners and corporations have locked in their debt so that the shorter duration debt from the government actually gets impacted earlier. And so that's something that I had to adjust as it started to play out. And by not being kind of like dogmatically fixed on a view, it allowed me that as this started to play out a couple months into this, I'm like, okay, no, there's actually like a trend change happening here. Another kind of estimate I had was that, Bitcoin would be higher than it, started the year, but not all-time highs for the year, which I think is healthy. Basically, you wouldn't want to see Bitcoin keep making lower lows after it already fell so much. That'd be not a great sign. On the other hand, I didn't really have much optimism. It was just going to, blow out. But again, that's like a very kind of low-key forecast. It's not hard for that forecast to be accurate. It's basically saying that, okay, I think we're seeing some signs of stabilization, but that I wouldn't expect a complete blowout. And it had a really good year on a percent basis, but it still ended up in that range of it's firmly out of the depths of its bear market. In Bitcoin land, we kind of view it as like another bull market just because of how strong it was and how much the energy changed. But if you kind of zoom out to like macro world, Bitcoin is still barely on radars because it hasn't broken all-time highs yet. So it's still in that kind of, intermediate zone. But overall for me, the biggest kind of interesting thing was watching this dynamic between fiscal and monetary and how the shifts of power, just kind of changes by quarter. If there's core developers being attacked, you can do things like contribute to their legal defense in some small way. Someone can send the equivalent of $25 or $100, which might not mean a lot to you, but if 1,000 people do it, they're able to kind of defend themselves. And so I think that helping others and doing, whether it's monetarily, whether it's just with your time, whether it's some small little interactions, those millions of people that can all do, small, medium, or large things that really add up if everyone does them.
Lyn stresses the importance of recognizing the unknowns in finance. Forecasting, she says, is about understanding where things might go without being too tied to specific predictions. This flexibility is crucial, especially when things don't go as expected. Then, Lyn shifts her viewpoint. Initially cautious about the government's financial control, she sees the strong stance of the Fed and the resilience of homeowners and companies with low-rate, long-term debt. Unexpected events widen the deficit more than expected, giving an unexpected boost to the economy. As we go through Lyn's insights, we see her adapt to the changing story. From predicting Bitcoin stability to unexpected government influence, her forecasts show the need to be flexible in the always changing financial world. Don't forget to subscribe to Bitcoin Zella for your daily news. The link is waiting for you below. The Crypto Street roller coaster isn't done. Subscribe, like, and join us as we navigate the twists and turns of the crypto world together. The adventure continues, and we're your guides on this thrilling journey through Crypto Street.